some of these hedge funds have made being short. That's without even going into the private wealth guy, guys like Druckenmiller. So, because they don't have to post, but that's what I've been maintaining is the Fed's in a war here. Somebody better wake them up because I don't know if they know that they're in a war, but they're in a war. Because they're just attacking where they can attack. And as long as the Fed keeps talking about unemployment and keeping rates lower for longer, but yet not doing anything on the long end, they're basically, it's like Obama's famous red line in the sand. Well, you don't hate when are you going to stand? When are you going to make a stand? How high? Again, the question becomes how high we let these rates go, and that's the market. That's what the market's now coming to terms with, and everybody's trying to figure it out. And it really is. There's no answer because you can't time it. But Powell's speech will be watched carefully, I guess, today. So. And I will be one watching it also.
I mean, I'm just looking at how the Dow and the S&Ps are trading up here and the relative strength. But, I think all in models are going to go neutral this week.
Yeah, I mean, okay. So why not? I mean, because but steepening yield curves are not negative equity markets historically. Of course, as I keep saying, we've never been here. So people who are forecasting based on what I don't give much to those forecasts because we've just never been here. We've never been where the long end can potentially wag this dog so violently and the central bank not react to it. That's the critical factor. And they told you they're not going to react to it because they're too concerned about the real rate of unemployment. Now, could they change in a minute with the release of all these vaccines? Yeah, of course they can do anything, but I'm not looking for that because they haven't. They've just keep talking about, and again, Brainerd's speech on what they say Thursday, Tuesday was one thing after another in the same iteration of they're concerned about those who have been most severely affected with the onset of COVID, and they will not be moved off that stance until they see some relief for those people. So, am I not to believe them? Okay, I'm believing in what they say until otherwise. Now, if they were to raise interest rates tomorrow or at next week's Fed meeting, 50 basis points, I say, okay, they're changing their tune. Fine. Now they've given me something. But until that time, we had Clarida, we've had Brainerd, we had Powell. They're all speaking the same. Mary Daly, the regional bank people talk about so much. I wish they'd stop talking. All it is market confusing, but everybody likes to hear themselves speak, probably including myself. I can be criticized for the same thing, but some people really have something to say.
Well, you want to hear nothing to say. All you had to listen to all the guys wanting to buy gold miners yesterday on CNBC. I mean, what have they been looking at?
Gold will have its day again.
Yeah, just not yet.
It's a tired bull, and it's being reactive to the 30-year yields, which we know what they're doing. So there's been a real constant. We've had some breaks in it, but those algos are still driving this. And until we get a serious break or an announcement of yield curve control. If you think yield curve control is going to take place, start loading them up. But you know what? I know that when I read that FT article about the huge money that's been made shorting when I say the long end of the curve, the longer duration, it's everywhere where the central banks are not buying. And it is across the board.
And that's the first area that Brevan Howard's hit in a long time.
Yeah. Well, how about
they almost blew up their fund?
Yeah. But and again, you're not talking about the guys like now again, Druckenmiller and Cooperman and everybody who, who the private wealth offices don't have to report like or releases the hedge funds do. And believe me, they're every bit. Listen to Druckenmiller. He told you in that Goldman podcast, when he sat down with the guy from Goldman for that 20-minute podcast, that he was playing, short short interest, on the longer term duration. That's what he told you. So we know that he's involved. A lot of people are involved. That's
Hey, Ira, one of the other things that I was looking for, remember that the supplemental reserve ratio for the banks ends the end of this month. And I think markets are waiting for Powell to come out and extend it for another 3 to 6 months, which is the mark-to-market rule.
Well,
and I think that, in conjunction with what's been going on in the repo market,
yep.
I think is definitely causing some angst, right? Yep. Because if the banks are trying to short their book, right, there seems to be a shortage of bonds out there, to get carry on. So I don't know. There seems to be a whole bunch of weird stuff out there. And again, I'm looking for Powell to make an announcement of the extension of that rule.
Okay, Angelo, but you bring up a even more important point, and I'm glad you did it. Now, on this week, Monday and Tuesday, we had a ferocious attack by Sherrod Brown and Elizabeth Warren about not extending that SLR, by the way. You know that. They are both, and they are two powerful people on the Senate Finance Committee. And they don't want that SLR relief. Now that gets more interesting, and which is really pushing me to a quick, if they go that route, okay, meaning Warren and Brown, if they go that route, that mandates that the Fed is going to have to step in with yield curve control quicker. So,
but you don't think that Yellen and Powell will pull those two in and say, listen, in case you don't understand the ramifications of your rambling, this is what will happen if you continue down this path. The banks are subsidizing stimulus.
Okay, but let me give you the foot, because I've thought about this quite a bit this week, and it's one of the started moving me to maybe think this is going to happen quicker. So if you're Warren and Brown, okay, do you want the Fed to embark upon yield curve control? I would answer yes, because the huge amount of debt that's being issued. You want to protect the long end. So if you say, well, I'm not going to give any more relief to the banks, let the Fed do the job here. So you could say that Yellen's going to bring them in, and now you're going to look at her and go, hey, this is pretty simple. The solution is pretty simple. And there's historical precedent for it. That's why I thought their comments, because they're not stupid people. They're not stupid people. Sherrod Brown is certainly not stupid. And Elizabeth Warren, while you may disagree with her on many things, I would never accuse her of being stupid and not understanding. So then I just raised the question in my own head: are they pushing for a quicker installment of yield? Are they trying to force the Fed? There's a lot of things in play here. If I'm in the government, I certainly, meaning the executive, I would love, and even Congress, I would love to have the long end of the curve capped, like we did from 46 to 51.
Yeah, I mean, if I'm a politician, right, I'm looking for the strategies that keep interest rates low so that we can keep printing or spending money.
Exactly. And not have to pay anywhere near a market rate. If the long end is going up, you're going to get to again, pretty flat real yields. So where 5 years and down are severely negative real yields, the 10 is approaching the accepted inflation rate. And let's see.
But doing away with the SLR, right, doesn't fit in with that desired goal.
Well,
it kind of complicates it to a degree.
It does complicate it, but instead of making the banks the warehouses for treasury paper, which is what removing the sustaining the present policy of exempting the banks from the supplementary leverage ratio, is so the Fed then does. So I tell you what, if I'm on the Senate Banking Committee and I'm looking at this, I'm going, do I want the banks, the warehousers? Well, not really. I'd rather have them lending money, which also gets into another interesting point about what the St. Louis Fed announced this week, right?
Yeah, I get that. I definitely get that. But what do you think if they do away with the rule? Okay, what do you think the next Treasury auction is going to look like? You think you think that the 24 dealers are going to bid last week's line in the sand, or are they going to bid with a substantial cushion in there?
Yeah, all great questions. And this is what the Fed has created, right? This is nobody's fault but the Fed's.
Exactly, for sure.
They have to own this. And again, I don't know whether you've seen it, Angelo. There's that piece in the FT this morning about the profits that have been made. I sent it to Judd by hedge funds, O'Day,
Robin Howard.
Let's go through. Kovner. Those are the ones who they're making a lot of money. And how do they make the money? Being short the long end of the curves in the U.S., in Japan, in Europe. They've been making money selling the curves. Now
they made another 20% being long the financials.
Yeah. Okay. And so yesterday, when that asshole Zero Hedge puts out a bullshit headline, and it's bullshit because there's no source to it. So it's whatever. So as being the supermarket tabloid of choice, which they are, they get a lot of ad revenue from it. So I understand it. But as Judd and I were going back and forth, and I said, watch the bank stocks. If there's any credibility to Powell announcing what they called 3.0 twist, which was, of course, yield curve control, the bank stocks would have collapsed yesterday. When I say collapse, that's a bad word. I hate using that word. They would have corrected from their massive rally over the last 2.5 months, right? I didn't see anything. No.
And to use Jim Bianco's example, he talked about, an 1,100-pound horse being tethered to a pole in the ground. The pole in the ground is representative of the Fed telling the market, look, we're not going to, let rates deviate too much, right? But if they let that rule go, that 1,100-pound horse gets spooked, and he yanks that pole out of the ground like it's nothing. And so you're right. The Fed has created this monstrosity, with coercing the banks with this rule, getting them to participate, warehousing treasuries as well, bidding reasonable bids at treasury auctions to keep rates down because the Fed is giving them the confidence that they don't have to worry about marking to market or any change in rates, right? And now here we are. But look, I believe rates are rising because we're getting that cyclical acceleration in growth, which is what's supposed to happen. Okay, yeah. It's just that, that's what's supposed to happen and has happened in this economic regime. 1999, 2013, 2009, right? But it's just that the system is built to be able to operate on such low rates with zombie companies and everything else. that higher rates, could potentially, be a huge problem when it
Well-
shouldn't be.
Well,
No. It only is, they've only put it in this situation. I agree with you that if you are going to get into a growth, bigger growth as you unleash, some of these savings and all this pent up consumer, potential consumer demand, opening up of stadiums, there's going to be a lot to come with that. But the Fed painted themselves in this corner by keep harping on the real rate of unemployment. Had they said nothing, the market would be able to do this. But it's now suffers cognitive dissonance.
all right. So now that we're into that conversation, what do you think what's a key point you're looking at for tomorrow's unemployment figure?
Right?
An
None.
acceleration in rate of change, as far as I'm concerned.
In rate of change of unemployment.
Yep.
So so give me the number.
I don't have the number. I just know up. That's what I'm looking for.
All right. So unemployment hasn't been, it's been irrelevant for months.
Yeah.
The question is, and we've seen numbers over, the last, 50 years go in and out of style. Now the question is it going to be market moving? Or are people just going to ignore it again and trade?
I don't think, even if you got a number, let's say, so where we at? 6.3, let's say that was 6.2. Hold on.
The bond market might not like it.
The bond market's not going to like it anyway, regardless, because unless the number is so bad that the shorts are forced to cover. Okay, let's.
Right. Yes.
And there's room
Agreed.
for the shorts to cover.
The market is heavily short here and very committed short, by the way.
Yes.
Right?
Yep. Oh yeah.
So the question is, what spooks them? And if it's, so we're looking for no change at 6.3, non-farm payrolls 185,000, average hourly earnings though, which I used to love. It's too convoluted here because so many people following the Fed's release of information, so many people at the lower end have been dropped out. So that gives an artificial, just by definition. I think average hourly earnings have been increasing more than normal, only because you're missing the lower extremities of your measure. So, except for what the government checks send out. So that's somewhat meaningless. Probably maybe the most important aspect of it will be the average hours worked, because that number's been growing. Because again, businesses don't seem to want to take on more people. They're willing to extend your hours.
Oh, and they're getting more productivity because everybody's working from home and nobody's traveling.
Yes, but we're talking in the productive sector. It's hard to measure that truly in the services. So, I'm just looking more in the productive sector, and that they're extending people's hours.
Yeah. I mean, Ira, everything else that I see is making sense. In this regime, you're supposed to get bond yields up, gold down, commodities up, oil up, industrials up, right? Financials up. All of those things, are doing what they're supposed to do in this regime, except for, the bond market potentially, causing some discontent because we're not structured for higher interest rates.
Well, you can see it in the board. The whole board's imploding right now. The only thing that's up is beans against the yuan.
Judd, I don't mean today. I'm talking about the last 5 months.
Okay, well, in the last 5 months, that's been the trend, right?
That's what I'm talking about. I don't talk day to day. I'm talking about what's trending, right? In order to match up the fundamentals with the market signals. And so it's doing exactly what I expected it to do, right? Now we have to see. Ira, I think our worst case scenario, if I can phrase it that way, is that the Fed just leaves this alone, and Powell just views this as a baby step in the direction of normalization.
Okay, that's fine. That's fine. And then you just and that's the unknown. That's the unknown that everybody has to deal with. Because if that's the case, there are certain things that have to happen. Of course, we're going to continue on. The dollar will probably rally because the U.S. interest rates on the long end do start to attract buyers as you get to real yields actually going positive, if that scenario is right, Angela. So we're going to.
But yes, and I agree with that. And rising rates is not just a U.S. centric phenomenon. This is, it's global.
Well, these same people are pushing around the globe. They're attacking the Australian. Why? The Australians have committed to a 3-year yield curve control, right? And
but but it fits but global rates rising, Ira, fits my bean counting, because everybody's accelerating.
Yes, on that which is they're not controlling, right? Now Europe is a different story. Europe is going to be a tougher story because I maintain that the ECB is exerting yield curve control now, and they can do it easy because they have 19 variables in which to play with on the long end. And because probably 10 out of the 19 already have negative yields on the 10 years, so they just go buy all they want of the others that are positive yielding just to make sure that they don't run wild and they can't easily be attacked. So they get to push back because they don't have the constraint, by the way. The Fed has constrained itself, and you can look at it by what their asset purchases have been that they buy on the short end. The same as the Australians, the same as the New Zealanders, the same as the Brits. They're all buying. We know that the ECB has actually been buying in the 10 years because that's what they've had all those different national banks been stockpiling, and the domestic banks. So they buy stuff with positive yields. So the ECB will be a much tougher nut. It'll be much tougher to get short the European bonds, even though they do follow what's going on, especially in the US, which then radiates around the others, because even Japan is running some interesting numbers, right? That the JGBs actually got up to about 18, I base, 18, 19 basis points. But it's an attack on they all have to wake up to it. Now, if you're right and they let it go, then okay. Then I would say gold for sure will go down to, I would say between 1480 and 1520, if they let that run its course, because the algos are telling me that. I can see what the algos are doing. I can see it every day in front of my face. So,
yep.
And the dollar will rally. Now, one of the great looking charts, and you can see who's getting rich. Judd, do the beans divided by the Brazilian real.
Oh yeah, it's that and the yuan. Hang on, let me throw it up.
And I use the real futures, so I'm using June.
Well, I have the. Hold on, I got the cash up here.
Okay, well,
here it is. I got them right here. There's the beans in the real, and again, this is putting in another engulfing bullish pattern again today, and it's just been doing nothing but going up.
Well, I mean, that chart is unbelievable.
Yeah, here. Let me make sure I'm on the right screen.
You see, they've taken out the high. That's Brazilian farmers. Anybody who's raising beans in Brazil, we're up to 80. What's the number on that?
Well, on this one, I was just looking at the yuan too. It's 80.75.
80 real to a bushel of bean, almost 81 real. And this is my point. Yet prices keep going higher, and we know the Brazilians brought in a massive crop this year again. It's a big crop. So my point, and I had made it with somebody's buying this. It's not just funds, because go out and try to find a soybean.
Yeah, well, look at this from 2020. I mean, look at a 1-year chart. I mean,
Yeah.
this is the most prolific, straight up thing you've ever seen.
Yeah.
And it's
And-
not over.
And we thought we had something to look at when you go back to that early high that was made by April when it was 50, and we were going, wow, 50 real. And that was all-time highs that people had slept through. They didn't even realize that.
Ira, at 10 o'clock, factory orders came out, and I haven't plugged anything in yet to be able to get a deeper rate of change read. But the very simple month over month. So January versus December, okay? January was up 2.6 versus December, versus consensus estimate of 2.1. So you're, at a very basic level, you're getting increases in all the metrics that matter from a growth perspective. Now, that's the goods economy, right? So this will probably eventually morph into, the services part of the economy,
Yeah.
but that's going to take a little bit more time. And that just feeds back into, why, I believed that rates would start to rise and have been rising. Now, I'll go back to last Thursday, because last Thursday, the bond market had that shit show, right? But I believe the catalyst was, the 8:30 in the morning release of CapEx and durable goods, which were off the charts. We haven't had rates of change increases in those metrics in years like that.
I believe that the catalyst was the miserable 5-year auction crop. And then, of course, we wound up with the 7-year auction, which was just as miserable. So, to quote Lenin, they were voting with their feet. And now we're seeing these voting with their feet are building massive short positions, which is challenging the Fed. So the Fed can say, keep doing it. We love it. We're making our case for us how successful our policy has been. And that's the Fed's position right now. It's a very complacent position going, okay, this is a transitory thing. It's just reflecting about how much growth they're expecting. But if you still do not provide any resistance, these yields are going to go a lot higher. And I have no problem with it. I'm not locking up with it whatsoever. I'm actually going to celebrate it because it'll unleash some forces that we haven't seen and allow markets to actually start trading. But my point is that the Fed hates markets so much. They hate the pain that they cause them. Hence the 2013 taper tantrum, the Powell pivot of December, January of 1819. So they really hate markets. So are they waking up and go, well, we need the markets to actually act as a signaling mechanism? And that's the unknown here. That's what we're trying to ferret out.
Yeah, and I fully, unless the Fed steps in with yield curve control in some massive way, I fully expect rates to continue to rise over the next 1 to 3 months.
But except on the short end, right?
On the long end,
right? And
the 10 and 30.
And that's why we're so different than we've ever been, because the markets have been much more susceptible to short end moves than long end. So this is going to break some new ground here. That's why the equity market has historically done well in the first phase of a steepening.
But the other driver of the buying in the short end, in my view, is, and look, it's never just one thing, right? It's always multiple things that cloud, what's really going on. But, a lot of bond funds are definitely shortening up their duration. They're getting the hell out of 30s and they're buying shorter paper. So that just creates even more demand for treasury bills, 2s and 5s.
Yeah, which is why, when you look at it, the Fed absolutely needs to go to Operation Twist yield curve control. Because they're crowding out those people at the short end and forcing them into negative rates. And I'm talking negative nominal rates on TV. Because the Fed is so active there.
They broke it, they own it.
100, yeah, you know what?
Yeah, well, we're not gonna be able to unbreak.
Broke it. Because again.
They broke it, they own it.
Yeah. So that's why I'm really interested to hear Powell's conversation today.
But I'll tell you one other thing. Hang on one sec. I want to pull up my high yield OAS spreads.
Okay, take a look at those. And then I want you
because they haven't budged.
I'm sorry, which one's that?
High yield spreads.
Oh yeah, I know.
They haven't budged.
I'm going to put up HYG just to give my. And this is really bothering some of the better
well,
economists.
this thing never moves.
I'm not really looking at that per se.
No, but it's a derivative of the same thing.
Damn, I can't pull up today. But yesterday, we were at 321. That's as low as the spread has been. I think it was like a couple days ago, it was 319.
You're talking about between the 10-year Treasury and the high yield, right?
Yeah, it's actually the Bloomberg Barclays, U.S. high yield average. OAS.
Yep.
Look at that sucker. It's basically flatlined. So there's no stress going on in the high yield market, which if I was worried about some sort of calamity,
right.
That's one of the first places that would sniff it out.
Yes. Yeah. But again, you make the case because people are being forced and they're buying corporate debt only because, even for 3.5%, they're salivating at that.
I don't disagree with that, but I also don't see any sign of trouble there either.
No.
Everything, all this angst is taking place in the Treasury market, which is where the Fed plays. Which is why I just said, they broke it, they own it.
Well, wait a minute. They play, but they don't play. They're only playing in one part of it. It's the part that they're not playing that has been put in play by the funds, by actual traders who are going, come and get me.
Yeah, the Fed hasn't gone after the speculators yet.
No, not one.
Not at all. They've just let them have free reign.
Yeah, and you know what? Listen, I applaud that. Except what makes me nervous and makes me vigilant to that fact is they've told me how much they hate markets and the ability of markets to upset their game plan. I can't say it better in my own mind than the Fed is in a war that they don't even know they're in.
The Fed's in a war with their kids. It's kind of like, us telling our kids, no, this is the way you do it. And our kids saying, screw you, we're doing it our way.
Yeah, you're a fucking idiot, man. Yeah.
That's what this is. The Fed has a bunch of unruly kids, right? And we're going to find out who's going to win.
Sure. U.S. Treasury.
But unfortunately, there's going to be collateral damage.
Yeah, well, the collateral damages of SPU bonds closed lower on the week this week. It's going to get real ugly.
Oh, yeah, and the SPUs have really had a rough week. I don't know why. Because when you really look at it, you go, okay, what are they going to do? They're not doing anything. The interesting thing is, there's
You know,
another,
so let's
Hold on a
talk
second,
trading.
Ira,
right.
finish the thought.
Euro Swiss this week and the last week, right? The weakness in the Swiss, where is this coming from?
Well, that's what I kept looking at it and I didn't know what to read into it because the Swiss was just kept trading below its 200 day. And I didn't really have I wasn't sure how to interpret it. I mean, and here's Euro Swiss at the 200 week.
Yeah.
So,
Thank you. I know, that's why I bring it up. And I, weeks ago, we thought, I said that the CAD Swiss was really looking interesting. It was.
well, it was Aussie Swiss that got my attention.
Yeah, yeah. And that took a while for that to happen, but that's a happening. So what is going on here with the Swiss? What is it, the Swiss? Well, the latest Swiss numbers don't reflect it. So I don't think that it's the Swiss intervening in the market. I think it's somebody who owned a shitload of Swiss francs for whatever reason, as a place that has been dumping Swiss. And I guarantee you, if that's the case, and the Swiss National Bank knows it, they'll help give it a push. That's what the Fed doesn't understand. They could they could jawbone a huge rally in the long end of the market. They could jawbone it, by hinting at it. They don't even have to expend a dime of money. And when they start doing the short covering, then come in and say, you know what, we're going to start buying some. So there's a lot of ways that they really wanted to affect the market, but I don't think that they realize that they're in a war.
Don't forget the Swiss National Bank owns all of that large cap growth momentum stuff, which is out of favor. Right.
Yeah.
And not to mention the fact that the Apples and the Amazons and all of that, they've got, some serious comps coming up, now and in the coming months, versus this time last year.
And there's no reason Apple doesn't drop another 10%.
Well, wait a minute.
Without a doubt.
They're not liquidating, because if they were liquidating, the Swiss would actually be going up. Because don't forget, they'd be converting all that stock back into Swiss francs, which then they could figure out a way to. So we're not seeing that.
Yeah, I think you're right. I think they're just sitting with it.
I just saw the numbers. Here, I'll read you the numbers for last year, okay? Because I do have them. Okay. Now, my dear daughter just wrote a piece, U.S. Treasury repo fails, surge as 10-year special intensifies. So they're looking for 10 years for repo. And, because, now those guys from Praxis just sent me, I'm reading it now. Let's see where that is.
Yeah, Murph's saying that the rumor on the street is that they're going to squeeze the 10s after Powell speaks. But I mean, you don't have to be a rocket scientist to know we've hit all the numbers in the 30-year, and there's no reason why it can't bounce.
Well, now all of a sudden, gold stocks just turned and went bid. I don't know why. Gold's now unchanged, just had a $10. Somebody got wind or thinks, again, I have to say that very carefully, thinks they have wind of something. Hold on a second.
Yeah, and so that's the bonds up, gold up.
Wait, hold on one second. Here. So, okay. This came out on Monday. SMB confirms 21 billion franc. So that's 23 billion US dollars profit on currencies and gold. That's not even talking about the portfolio. Although some of that is due to foreign currencies that they buy to purchase, equities in that domestic market or wherever they're buying them. So, and they're distributing, let's see how much. Oh, they're paying out 6 million francs, 6 billion, francs. So that's about almost $8 billion. No, I'm sorry, about $7 billion. The federal government cantons, that's what they do. The dividend the shareholders will be 50, because you can own Swiss bank stock. I tried to buy it once, non-successfully. It's not easy. So paying 15 francs per share. So they made 24 billion on foreign currencies and gold. That's not including all the dividends that they collect. This are fascinating times. We're seeing a whole lot of things. And again, pay attention to the, because if there's actually going to be something coming, the bank stock should then, correct pretty good, because its curves will stop steepening and they'll actually flatten fairly dramatically if the Fed decides to get involved. We'll see. I'm
Yeah,
sorry.
And you're already seeing, Goldman's already off, $7 off its high. So
Yeah.
somebody took their money today. That PayPal, Square, all credit card issues were in profit taking mode this morning. So somebody's squaring up on a lot of things.
There's also a deer. Look at this again. It's a third day of beating.
Yeah, but I only care about AGCO.
Yeah, we're holding up. Bungie is also holding up, Ira.
Yeah, you know what? It got up to $81 yesterday. Nice call, Judd, because I know we had pretty good resistance there. Again, I cut, it's basically hanging where I cut a third of my position. I'm holding on. I think that there's something going on there, because it comes. But when you look to see, Robert, I don't know what time you came in, but when you 81 real to a bushel of soybeans, how they doing down there?
Down where? I'm sorry?
Down in Brazil.
Oh, I don't have the yields yet, except I know that we have more and more machines in there, in all three regions, Mato Grosso, the Sul, and the Goya. So all three regions are just humming, and they're saying, send more machines. I'm sorry, I don't have more, but on the Bungie, you're absolutely right, because I've been doing some research yesterday, and it's a phenomenal company. I don't know how I missed it. It's on my list, but there is so many statistics, but return on equity, 41%. Cash flow, $11.86. It's a money machine. They pay a yield 2.5%.
They're huge in Latin America. Huge.
Yes.
They've always been.
Funds are still adding to it. The funds own 49% of float. In March last year, they had 996 funds invested. Then in June, 988. September 20, 1006, and now December 20, my latest data point I can find, 1100. So somebody is buying, and it's not just Robert and Ira.
You know what? I went back and looked, I started buying it at $35 last year.
You made an excellent decision.
I mean, look at this semi-annual. I mean, it's basically, it's done in 8 months. It's just done a 50% retrace of the life of Bungie.
Well, Judd, and Notes from Underground was
You were all over that in Freeport.
In April. And then when I did the podcast with Louis Gabay and with Mark Faber, they were also very bullish on it, and very interesting. That's all I'm going to say. Very interesting. Robert, Robert, look at soybeans priced in terms of real, and Bungie is printing money.
Yes, they do. And it's the size of AGCO, 10 billion. It's not a large company.
No. And, there was talk, that there was going to be a takeover. That's why you wonder about some of these corporate boards. When are you going to wait for? Back when things were really falling apart. But I know that Glencore had looked at it. Anybody who really wants to get into the grain and food business, global food business, you're out of your mind. Not to AGCO should be buying it.
Oh, yeah, that business that Bungie is, I dare to say it's better than Deere and AGCO because we original equipment manufacturers, you can always multiply them. You know, Kubota is getting in, even Mahindra from India. But this business, there's a huge barriers to enter. You cannot just turn on a dime and say, okay, now I'm into the edibles, oils processing, or fertilizers. That takes a lot of know-how
You know,
aside from capital.
40 years ago, and I'm pretty sure that's the exact date, there was a book out that I read. Because I thought I knew a lot about when I was studying multinational corporations when I was in graduate school. You know, I kept coming around the grain companies, but I read The Merchants of Grain, you know, about just like what was it, the seventh,
That was a great book. I mean,
That
a
was
great book.
understanding how this all works. Let's see, Cargill, Archer Daniel, Bungie,
Louis Dreyfus
Louis Dreyfus.
and the guys from Continental that are no longer.
So those were the 5 huge grain companies, just like the 7 sisters in the oil industry. You know, those were, and what's his name, Daniel Yergin's book. Those came out around the same time The Prize, which was a great expose on the global oil game. Really, I learned so much. I can't begin to tell you. But Robert, the barriers to entry, and you can't redo this. You're not going to reinvent this because number one, their impact on global shipping. Robert, you could walk us all through this. This is what your life is. So what the hell? I'm not doing that.
No, yeah, man, you got it. It's actually a nice company. Sometimes, I hear, and then I finally looked yesterday in a few more statistics, and that is a nice company.
Okay, so I'm going to be buying AGCO when it gets down to $80.
That would be probably a good steal.
I really missed it when I was getting very long on the eggs. I was just buying the grain producers because I just respect that business so friggin' much. You know what? Because you got to eat, right? And they were so unloved.
Yeah. Especially last year. I mean, this was just, and we talked about it at the time too. I mean,
Yeah.
Robert's former CEO down in here in the 50s was buying his stock.
Yeah.
On that sell-off. When was it? In July last year?
It was in May when we had the window open and we could purchase right after the earnings when we are allowed to trade. Martin Rischenhagen just said it was $48 or so. It was traveling. It was trading in 40s, mid 40s, and he says, "I'm just going to buy with my own cash," and he did this, and he sold in November when he was getting ready for retirement. In high 80s, 90s. I think 80s, most of it. He took a half of a stake out. He has left another half. A prudent man.
Wait a minute, hold on. I'm going to have a tag day for him.
So now we have a new CEO, Eric Hansocha.
Hey, Judd, anybody in this room own a B2 seat? Because I'm running for the board. I need everybody's votes.
Well, it's Chicago. Maybe we can find some dead people and have them vote for you.
No, they don't. This is too honest an election. It's the one thing that certain regulators do right. In fact, if you're alive, they make it tough enough to vote, let alone dead.
I don't know. There might be 1 or 2 guys. I don't know, but I'll ask around. I'll put it out there. So you need guys of the B2 seat?
No, I'm on a mission. I'm probably,
Okay.
but last year I came in third and lost by a few votes. So I figure if I could shake it up, I was hoping to get on the A slate, but in times of COVID, I talked to some, they were just not looking to make any major changes. Maybe some of the short, let's see what kind of rally takes place in the bond markets ahead of Powell. Will these shorts get a little nervous?
Yeah, I mean, the bonds aren't moving that much, but the S and Ps went down there and challenged that low and didn't get low enough. So I think they're done for a while.
On Tuesday night, I put on the greatest trade, and because I overtrade, and I always I have to learn that lesson every day not to overtrade. Put on Canada and short the S&Ps. Because at some point, a lot of these positions, the algos, I just wait for some of them to start to break down. And yes, interest rates are going higher, but when I really look at it, up to this point, the dollar really has not responded, right?
No,
So the dollar has just been, because nobody's really enamored with the dollar. And if the Fed, rather than opening up swap lines again, I would tell them, if you want to understand markets, go to yield curve control, because that'll help weaken the dollar, which you've been trying to do anyway. I just, yeah. And now all these people are coming out, even Dudley, who I can't stand, had a piece out this morning.
yeah, I saw that, and I read that FT piece yesterday.
So there's, but it's still the same discussions. And, I'm proud to say we've been on top of this long before it became a mainstay, because you can see it's coming. I mean,
No, we've been talking about it for 2 months. When does the long end of the curve affect the indices?
yeah, it's still the question.
All right, so I got one more question for you. What did you think about Lizzie Warren's thing last night about taxing these guys 2 cents on the dollar?
Oh, you mean for
Super rich over 50 million.
Well, she's not going to let up on that. So-
She'll never get it done, but it's an interesting concept.
Yeah, and that's what Sanders had put out. There's some economists who've worked on this. She will not let up on it, but I'm kind of surprised because she's got some other fish that she's going to fry, and that's on the bank regs. And Angelo, are you still on?
He's sort of he's in, but I don't know if he's
probably eating his oatmeal. I don't want to disturb.
no, he's eating a dead fish sandwich.
So all of these become very critical, but and Angelo's right. They need to just take and again, these are not stupid people. You listen to Sherrod Brown. Sherrod Brown knows a lot about banking. He does his homework, and I've always liked him, even before when he was when they weren't the majority party and have control of the committees. Sherrod Brown's was highly respected on that committee, because you could even see when what's his name, who chaired from Alabama, who chaired the committee and is now the ranking member, which was Sherrod, but he would always give Sherrod Brown his say. So that was he's no fool. And their disdain for the banks, for the Wall Street banks especially, which is why, right now the Wall Street banks, because of the yield curve, have raced ahead of the regionals, but that's one spread I continue to watch.
Well, here's the other one here. Aussie yen double bottomed. And if you can just, and I look, that is coming back up as risk on, and it bottomed with the S&Ps.
It's I can even make the case on a weekly as an inverse head and shoulders. So we could probably get back to where, probably about 90 cents, right? Go test that high we made in 2017.
Yeah, it's going to have a big problem up here in the next figure with all these monthly moving averages, but I agree with you that it wants to go a little higher.
And again, we were always amazed with the Aussie, because it was rallying, as how many times we discussed it with Andrew. It was rallying even as they were openly, to use street language, beefing with the Chinese over tariffs. We kept going, wow, this currency should be getting hit by the political aspect, and no, it kept going higher. But I'm going to click out for a while. I will stay attuned. But Powell's speech, it becomes very significant today. and maybe Zero Hedge had something. I don't think so, because somebody forgot to tell the bank stocks, and you know, the bank stocks are still hovering up at their highs. So I'm not seeing it, because I would expect a pretty good, you know, maybe a 20-25% correction of the recent rally. Because look at even JP Morgan rallied 50%.
Yeah, I mean, JP Morgan's had a huge, and it's been pig's fly time that Citigroup has actually started to pick up.
Yeah, wait, let's see that. That's the biggest pig on the block. I mean,
If that was good, that thing would have been trading at $200 now.
for sure, because when you realize that after the the reverse split, if you go back, the high was made in 07, 06, December of 06, interesting, at a reverse split price of $570. So as I said, if I was Lizzie Warren, yeah, I'll ease up on regulation when Citibank makes new all-time highs, because that'll tell me that the banks are really healthy. And that would be market response. Hey, you can't argue with the market. But I mean, if I was a wise guy advising her, that's what I would say. And go ahead, argue with me. We'll keep an eye on the bonds. Especially these curves. Now, 30-year even just went positive for the day. Okay, you guys.
Thanks, Ira.
This is really good discussion. Angelo is on top of it, but everybody is waking up to this.
Yeah.
Ira, do you still like Commerce Bank?
I do, but that's a very limited reason why I like it. I just think it's going to be put up either for merger with Deutsche Bank, which has problems after problems, but even that stock, let's see, where's Deutsche Bank? But Commerce, to me, they've been talking about that merger for, let's see, I'm 67 years old, probably for the last 20 years anyway, where they wanted to merge them to create one giant German that would dominate all of Europe's finances anyway. They've never been able to get it done. But now that I see that Cerberus, when I read that article, so, it's a low risk play for me. I'm not going to, if I risk $1.50, that'll be a lot. I initially got a thrust of about 10% really quickly. I don't know, where's the trading today? I mean, that's why I put that on. I have no other reason for it. Let's see. Yeah, it's at 651. I still have 5% made on it really quickly. And again, it's to me only because they are going to get its house in order, cut its expenses in an effort to make it either mergeable or just put it on the block and sell it, especially because Cerberus is stuck about 300 million on the trade. And if there's one thing I know about them, they hate it. So they're going to try to figure out their exit strategy. So I'm just going to try to make money based on the way that I believe that they operate. So.
Interesting, thanks.
Who asked that? I'm sorry.
David.
Who?
David Stewart.
Okay. Yeah, that's it. There's nothing else to it. There's no magic. Right.
All right. Thanks, Ira.